Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview, and I'm delighted today to be joined by Mr. Tony Foster, who is the CEO and CIO of Marine Capital based in the UK. Thanks so much for joining us, Tony.
My pleasure.
Great to have you on Halftime Talk. Well, there's no shortage of things to talk about in shipping these days in the maritime sector. Let's start with, the obvious elephant in the room, which is the Russia-Ukraine war. And of course, that impacted so many things across the energy space in particular and across all trade and shipping, and continues to do so. So let's start with a sort of overview question for you, which is, in general, has it completely disrupted the maritime ecosystem, would you say, or have things adjusted now 1 year on?
Yeah, so clearly the most obvious change is in trade flows, which have been dramatically affected, particularly in the tanker market. Before the war, Russian crude was moving probably 80% into the Atlantic and 20% into Asia, and now that's reversed. So China, India, and South Korea, for example, are buying a lot of Russian crude at discounted prices. And for product carriers, of course, we have Indian refineries increasing their margins and selling products back into Europe. And we've also seen refineries in UAE doing the same thing. Saudi, UAE, 300,000 barrels back into Europe for refined products. So all of this is a result of the war.
And I mean, how, in terms of how that's impacted, let's say, tanker rates. I mean, obviously a year ago they were one thing, today there's something else. And the dynamic sort of outlook for that going forward now, would you say that we've established new rates? We're pretty steady as we go at the moment?
Yeah, so what drives freight rates is distance multiplied by volume. So clearly what the war has done is to multiply the distance. And so the utilization in the tanker market has increased, rates have increased or jumped, as you will all know, very significantly. And those elevated levels look likely to be sustained for quite some time. I mean, we could be talking years. Of course, the issue around sanctions is complicated. Nobody knows how long the war will last, and nobody knows how long sanctions will last, even if the war is ended. So the prospect of elevated tanker rates for quite some time to come is a very significant prospect. Is a high percentage chance, I would say.
And how are in terms of Russian products, which are now obviously under the microscope, crude has sort of settled in to the Russian crude, obviously was going, as you said, to India and China in much larger volumes than it was before, and that looks like it's set to continue. Let's talk a bit about that actually before we talk about products again. In terms of the sort of dark fleet versus clean fleet scenario, again, we've always had a dark fleet of sorts roaming the seas before, but clearly that's taken on a whole new life in the last year or so. How disruptive does this continue to be for insurance markets, for financing that trade, etc.?
Well, you're right. The dark fleet is now very significantly bigger than it was before. I was just reading somewhere that Trafigura have suggested that it might be as much as 600 ships. The total is certainly somewhere between 300 and 600, and includes, for example, 100 VLCCs, which is a huge percentage of the fleet. As far as insurance markets and capital markets are concerned, I think it's fair to say that all Western insurance markets and capital markets have completely boycotted any Russian connections. And so what's happening is that those dark ships, for example, have to be registered in Liberia or Panama. Companies that want to trade effectively sanctions busting are registering in new locations, many of them in Dubai, interestingly. There is a significant subsidiary of Sovcomflot, the Russian shipping company based in Dubai, which is quite likely to be sanctioned very soon. The price of old tankers has gone skyrocketing because it's only old tankers that these traders have been buying. That's causing knock-on effects because the safety risks of operating these old ships is significantly higher than it would be if you were operating more modern ships. So there are all kinds of issues that are quite likely to arise with oil spill or safety over the coming months, as long as these trades continue. And
Well,
when it comes to classification or insurance, these ships have to be insured somewhere else. So China or indeed Russian insurance companies. So apparently it's costing the Russians huge amount of money to provide this cover.
Okay, I mean, you mentioned the safety risks associated with the older ships. And interestingly, the other angle of that, of course, is the whole replacement of ships with cleaner, cleaner sort of new builds that will be taking the cleaner fuels, let's say, in terms of IMO 2020 onwards, and all those new directives that are coming from the associations for ship owners to adopt. So has that left them, for those who are looking to make new investments in new ships, where does that put them, basically, when you haven't got the scrap being scrapped, if you like, at the rate that we were expecting, maybe?
Well, there are lots of issues. It's really quite a complex question as to what's happening for fleet replacement. And sort of it's a sort of where do you start question. The key issue around fleet replacement, or the key consideration that people have been thinking about, is future fuel and what that future fuel will be. And at the moment, there is clearly no certainty as to what that future fuel will be. There are a couple of front runners, ammonia and methanol, and a lot of decisions on fleet replacement have been put on hold while more clarity emerges. And in addition to that, more clarity is sought around the IMO's timeline for reducing GHG emissions in the fleet. So there's a body of ship owners that I would say the traditional ship owner will follow regulatory requirements and say, my job is to comply, and as long as I'm complying, that's fine. And so I'll just wait and see what the IMO says next. And there are others who are more proactive, who are taking the view that yes, now is the time to future-proof our assets, and go for ammonia or methanol, or in some cases both, hedging their bets on both. But if you look at the total of new ships ordered and the percentage of that total represented by dual fuel capability other than LNG, it's very small. And the other thing to note is that whereas you will see reported in the press articles suggesting that a ship has been ordered which is ammonia ready or methanol ready, they aren't actually ready. What they are probably doing is effectively making the layout of the ship suitable for retrofitting to ammonia or methanol in the future. So there's a future piece of retrofit work to be done for that ship actually to use ammonia or methanol. So lots of issues from the perspective of investment in new ships. Lots of issues still outstanding. Lots of issues
and lots of risk, I suppose, financially in that sense. Let's talk a bit about the products, as we mentioned earlier, products, markets, and shipping for that. So two elements. We've got the Russia equation, where we're going to see some of its products. Would you say certain segments of its product slate are going to be hit more by these new sanctions than others in terms of finding new homes? Gas oil, some say it's reliant on Europe, but it will find somewhere. Clean products, not so much. Do you see a sort of impact there in terms of on shipping as well as market prices?
Yeah, I think it's more a function of price. So if you see, I mean, the Russians will presumably sell whatever they can sell, and therefore it will move somewhere at a price, and the tonnage will be found to move it. I mean, beyond that, it's quite hard to say.
Yeah, and of course the cost of that tonnage, if it has to navigate around different routes. And
Yes,
China, of course, we saw quite a turnaround in the last 2-3 months in Chinese refining coming back sort of online, if you like, being allowed to export by the state. And again, a lot of that happening in the last month or two, a lot of inventory that they're using to do that, crude inventory. Is that impacting the Asian shipping rates, Asian shipping flows in any particular way more than before?
Yeah, I mean it's always a global market, so rates are affected globally. Yes, there are differences between one basin and another, but those differences in the spot market tend to equalize over time. Ships will move from Atlantic to Pacific if there's more business in the Pacific. So those rates will equalize. And of course, you know, the issue about products is it's ironic, isn't it? We talk about sanctions, and here in the West we are very committed to the sanctions regime, but it's full of holes. And the idea that refiners will be making larger margins and exporting those refined Russian oil back into the West is somewhat ironic, to say the least.
What about LNG, Tony? Let's talk about spot LNG buying and the impact there on those tankers, if you like. You've got the term contracts that are still in flow, and then of course, yes, last year in Europe, huge demand on LNG into Asia and Europe. So, you know, where would you see that going
Yeah,
forward?
so that's also, you know, the thing to think about there is also distance. So what happened again after the start of the war was a scramble, particularly in Europe, to secure gas supplies, and so that was hoovering up whatever gas was available in the spot market. But as most of the spot gas was coming from the US, so for that reason, the distances that the LNG tankers were traveling was not necessarily longer. So you had, in terms of freight rates, you had for a time, you know, weaker freight rates because the distances were shorter. But what you also had last year, in particular, was traders making huge amounts of money on spot LNG cargoes. So as that scramble took place, traders could afford to have LNG tankers just sitting off the coast of Rotterdam, waiting for an opportunity to resell, and that did drive LNG freights temporarily very high. You know, there was $500,000 a day at one stage.
Oh, goodness, yeah, a lot of money to be made last year in gas, definitely.
Particularly the trading.
The trading, yeah. In terms of container rates, again, container freight rates, again, you know, that's obviously impacted a lot by you know, trade of dry products, if you like, consumer products as well. The outlook for that, given export markets for Chinese products to America, etc., consumption patterns, expectations in Europe and the States, of course, that's not predictable necessarily, but a slowdown, certainly, you could argue, again, having had a bit of a recovery post-COVID. How does the container shipping market, those who own that freight, the shipping for that, sort of act going forward now with all this uncertainty about where the global economy is going to be in 6 months' time?
So COVID was a massive bonus for the container market. And like many events in the shipping market, unanticipated. The short-term shipping markets are always event-driven, and nobody sees the events coming, which is why ship owners tend to keep their ships in the spot market, because they know something will happen. They just don't know what it's going to be. So in the container market, two things happened. One was because of COVID, port efficiency effectively collapsed because people couldn't get to work. Lorries couldn't deliver their boxes to the ports. Logistics were backed up everywhere. And so ships queued in port waiting to load or discharge. So clearly, again, that drives up utilization to unseen levels. And in addition to that, lockdowns, particularly in the West, made people sit at home and buy furniture online.
Yeah.
And fill boxes with it, most of which was coming from the Far East. So that had a double hugely positive effect on the container market. And those lines made, as you know, many billions of profits in the last couple of years. Not a lot of it, but an amount of that has been reinvested in new ships. Quite a few of those new ships are going to start coming through in the next year or two. And the container market, which has dropped very significantly, will probably stay at a fairly controlled level over the next couple of years. There are more challenges ahead for the container lines in the next couple of years than there were in the last few years, but they've got plenty of money in the bank.
Okay, so what would you? I mean, let's take a look forward a bit for the next couple of minutes, and what would you define to be the top three sort of concerns or trends to watch out for in the next 6 to 9 months as we go through this year, with all the dynamics that we know are there in terms of macro and war? What would you say ship owners' three biggest concerns will be?
Three biggest concerns. So deciding investment decisions are more challenging now than they have been in recent years because of technological change, and you have to form a view as to whether your asset or the type of asset that you operate is one which is more or less susceptible to change and the speed of that change. And it's really quite a challenging decision. All the things that go into future fuels, whether it's port development, whether it's energy companies, making big decisions, whether shipping leads or follows the rest of the industrial world. These are difficult questions which ship owners are not, well, nobody really is fully equipped to answer, but certainly ship owners, it's too much for them to have to think about, which is what's delayed all the investment decisions. So that's a big one. I think financing is another big one. The war, I think, has thrown a bit of a spotlight on the key financing mechanisms in the shipping market. So, one of the effects, for example, is an increasing reticence amongst some ship owners in the West to do business with the mainland Chinese. And that's because the Russian activity in Ukraine threw a spotlight on China's attitude to Taiwan. And that in turn made ship owners think, okay, well, if I've seen what's happened after the Russian invasion of Ukraine, I've seen all the ships connected with Russia, I've seen all the financing pulled and all the ships sold immediately in the market. I couldn't afford to have that happen if I've got my ships leased from Chinese and they did the same thing over Taiwan. So, that's a very interesting question. And US-China tensions are clearly at a very high level, elevated level. And I think that has a role to play in financing. And in the broader context of financing, you have the issues around decarbonization and ESG and how the banks are viewing that challenge from their perspective. and how they are addressing it and what that means to people that want to borrow money.
Do you think that the banks and the whole ESG sort of criteria that, of course, has been rising in terms of finance criteria, but some would argue today, because of energy security, because of all the other dynamics, that's kind of taking a slight backseat to sort of today, sort of, you know, the immediate reality? And do you think banks are also going to, or are adopting that slightly less strict conditioning that they have been placing to finance certain practices?
Good
Along with
question.
the SPV, you know.
Good question. I think it probably depends where they are. I think if they're European, the answer is no, they're not changing. The policies are very well set. The EU is very committed, ostensibly very committed to its policy, and European banks, certainly some that we deal with, are finding it increasingly difficult to find, for example, shipping projects that they are actually able to finance because of their increasingly demanding criteria on decarbonization. I mean, there are, you know, as we sort of half jokingly say, that there aren't enough electric ferries around yet for people to finance. So you know, you have to think about how you can help the transition. How you know, what is the what criteria are you going to use to help ship owners to decarbonize their assets, rather than just saying we're not going to provide you with funding?
Yeah, and certainly it's that, you know, that is the word, isn't it? Transition, and a big argument being made, obviously, by the energy industry, whether it's the shippers or otherwise, that, you know, we need to be more patient with the transition and tolerate everything else in the meantime.
Yes.
You know, which is true, but, you know, then you have the naysayers who would argue otherwise. Tony, before we let you go, just you touched on one thing in that top sort of three concerns question, which was that, you know, the shippers and the ship investors in shipping finding it hard to make decisions, obviously, for different reasons. One is these sort of IMO, you know, directives, which the last being 2020, which was quite well complied with from all accounts. The sort of panic over it dissipated a bit, but, you know, like, what's next, and how can we possibly plan if every year we're going to have new, you know, restrictions put on the sulfur fuel or whatever we burn in our bunkers? And a lot of people say, you know, who does that essentially, that responsibility ultimately lie with? You know, you've got all these stakeholders, but, you know, do you think it should be governmental? It should be policy that is, you know, putting these things in place and taking responsibility for that, or should it be the shippers who have to comply? I mean, who's going to be responsible also for making sure that compliance happens at ports? You know, so there's so many of these stakeholders, and nobody, you know, everyone seems to be sort of passing the buck, if you like, and not getting clarity.
Yeah, so I think it's sort of lots of questions there in a way. Yeah. The answer is there will be carrots and there will be sticks. There are certain key elements which probably have to be factored in. One is carbon pricing. So I think it's pretty much universally agreed now that there should be and will be carbon pricing in the shipping market. That will be an important change. It won't narrow the gap between the price of diesel and the price of ammonia or methanol, green ammonia or methanol. It won't narrow the gap, but it will help directionally to make that change. As far as the regulator is concerned, the current outlook is one where we have a tightening of the screw year by year. So these are some current regulations called CII. Those regulations oblige ship owners to reduce their emissions by a certain percentage every year. And that's understandable, and people are complying. Yeah, there are some questions around enforcement and penalties, but essentially that will be complied with, and it's quite likely that those regulations can be tightened and will be tightened. Whether or not you can do better than that or quicker than that, that rather depends upon your corporate policy. So if you're a liner company or a huge public company or a ferry business, if you're facing the public and you're answering to the public about your decarbonization strategy, then you may set your own targets. And you might say, well, the IMO's target is 2050, our target is 2040 or 2035 or whatever, and then you'll work on that basis. But there are still lots of challenges. One of them, just to give you one, some of the new tech that we need on ships and can use, we don't have measurements. We don't have the data to show what that new tech will actually do for us. So owners are having to invest in tech without knowing how many percentage points improvement they will get. So that's difficult. And also, they're not cumulative. You can have 5 different pieces of tech, each one offering you 2%, but the total won't be 10%. So again, the investment decisions in the improvements are also complicated.
Yeah, and you can't necessarily forecast it. As I said, it's moving so fast, that tech side, isn't it? I mean, we all know that from owning telephones. It's outdated within a month of spending the last $1,000 on your phone. And so imagine in this big bad world of shipping,
that's right.
How difficult that is. But that's, I suppose, the risk of investment, if you like. But Tony Foster, thanks so much for joining us as CEO, CIO of Marine Capital. I'm afraid we've run out of time, but great to have you on Halftime Talk.
It's a pleasure. Anytime.